Hello class and welcome to our fourth lecture series on financial accounting or principles of accounting. And I'm your instructor Jamal Haider. Okay, in our last lecture we were talking about the rules for debit or credit. What we have learned that if there is increase in asset, so don't be confused with the word positive and negative. Positive mean increase and negative means decrease. So if assets increase, what we call that? We debit. And debit mean the left hand side of the account. And if asset decrease, it means we will record it here on the credit side. Right? Now, if there is liability, if liability increase, then we would take it as a credit. If liability decrease, then we will take it as a debit. And where is debit and credit? It's always on the left side is called debit and right hand side is called credit, right? Similarly with the stockholders equity, we call it SHE. If increase, we call it credit. If decrease, we call it debit. What do we mean by that? The left hand side is called credit, right hand side is called debit, and we have our shareholder equity account here, right? And then we talk about two things, which is the dividend and expenses. So you can ask a question that, sir, dividend belongs to stockholder equity, expenses belong to stockholder equity. Then why there is increase in expenses causes credit, and also the dividend causes credit, and why decrease causes debit. And we talked about that because increase in dividend and expenses, any kind of expenses, whether these are rent expenses, utility expenses, okay, except prepaid expenses, because prepaid expenses are our assets, not stockholder equity. So we increase in dividends and expenses, basically they decrease our stockholder equity, right? So any increase in dividend basically decreases our stockholder equity. So that's why increase in dividend causing decrease in stockholder equity, so we make it debit, right? So any decrease in dividend or decrease in expenses would be considered as increase in stockholder equity, so we will take it credit. And if you cannot digest this explanation, then remember this one, a very short one which I don't recommend, but since it is in your book, you can call it, there are two exceptions to this rule of debit credit. If dividend occur, always debit. If expenses occur, always debit, right? The explanation I already have given, but if you don't understand, then just remember this one. There are two exceptions to the rule of debit and credit. Number one, if dividend occur, always credit. If expenses occur, always debit. But remember, these two accounts belong to stockholder equity. Some of you guys, they confuse why They confuse these with the asset, because asset increase mean debit, asset decrease mean credit. So they think that dividends are asset, because if asset increase debit, so dividend is also debit. If expenses increase debit, so dividend, so assets also increase at debit. So dividend and expenses, they are treated like asset. No, they are not asset. Remember, they belongs to stockholder equity. So if we understand all the rule of debit and credit, so let's move forward and talk about the real stuff. So just go through with this diagram. See, asset increase debit, asset decrease credit. On the other hand, liability increase credit, liability decrease debit. And then we have stockholder equity account. So this is a bigger picture here on the downside. So if stockholder equity increase, credit, retained earning increase, credit, revenue increase, credit. If common stock decrease, debit, retained earning decrease, debit, revenue decrease, debit. But there are exceptions with the dividend and expenses. If expenses decreases, then we call it debit. Credit. If expenses decreases, we call it credit. If dividend decreases, we call it credit. If dividend increase, we call it debit. If expenses increase, we call it debit. And now our foremost awaited moment has come. We are now actually diving into our real principles of accounting or financial accounting stuff, which is record. Record means journalize and post transaction in the books, right? So the account title that we are going through, like cash, inventory. So basically they are in real life when you go to the factories or you go to the companies. So it's not like an account, these are books. We call this books of account. So they're going to be a book, and on the face of the book there would be written like cash book, inventory book, right? So every transaction occur, so you make a recording and you post in those books, inventory book, furniture book, vehicle book, right? So there is a physical record. But since the innovation of technology, now these records are maintained on a parallel basis, which means we are maintaining the soft copies as well as hard copies as well. So all the books of accounts, we are also posting the entries on the books and also on computers as well. So since the innovation of all the ERPs, the entrepreneur resource management, so you just enter, because there are different logarithm and different softwares, loop analysis over there. So everything is going automatically to the accounts, and then you just print it and then just keep or just post or maintain the books accordingly. If it's cash book, inventory. So what is the logic behind that one? Today we will learn about that, how this entry is going through all these processes towards the cash book. How they are posting. Okay. Now journal. So journal is a chronological record of transaction, which means we have to maintain the journal according to date, which means there is some kind of order, right? It's not like that January 1, January 2, January 3. It's not like that. You open the book, you see that January 3 transaction is before January 1. If that happens, then it's not recommended. You can say that there may be some kind of error, or this may lead to a fraud. Okay? So it's a chronological order. So there are 3 steps to make journal. Number 1, specify each account affected by transaction and classify by the type. If any transaction So remember, at least it would affect two accounts. At least. It can affect more than two, but at least two account. Which two account? You classify either these two belongs to both assets or asset on the other one is liability or other one is stockholder equity. It's like that, right? You specify that one. Number two, you specify which one is to be credited or debited, which one increase or decrease, right? And again, I'm saying that debit doesn't mean that it's positive number, because debit it can be increase or decrease. Okay, so just remember in terms of if the account is decrease or increase, you see its specification and then you act accordingly. We'll talk about when we do the real stuff, and then you make a journal entry. That's it. So let's move forward. So in order to make journal entry, the journal looks like this. So it's a chronological order. We must have a date here, or transaction number or serial number, right? 1, 2, 3, 4, right? And a date here. There is.
It's kind of invoice.
It looks like invoice, but it is a journal. Invoice is something different.
Yeah, okay.
Right? It looks like that, but it's something different. Okay? Because invoice is related to just one thing, sale invoice, that's it. So journal is basically the chronological order of recording of all the transactions, right? Sale invoice means it only represents only sales, not the expenses. But journal recordings, they mention all kind of activities. If you find out 1 month journal entries, then it talks about every kind of income, expenses, sales, rent expenses, every kind of transaction that a business go through during the month, you have to record in journal, right? So now let's apply all these 3 steps to a transaction. Number one, business receive 50,000 cash and issue stock. So this is the transaction. Number one, specify the account, which account it is going to hit. So this transaction, recall your knowledge or your practice through the accounting equation: liabilities plus owner's equity. Asset is equal to liabilities plus owner's equity. So business receive cash, it will hit cash account, and issued stock, it will hit the owner's equity or stockholder equity, right? So we specified 2 account here, cash and owner's equity. And which owner's equity account? Common stock or paid, or just paid in capital or common stock. The basic thing is when you issue stock, it is a common stock, right? So you specify cash and common stock. So what happened to cash and common stock? Business receive cash and business issue common stocks. So common stock is also increased, cash is also increased. So that's why both are increased. Now you find out that increase mean what? In cash, cash belong to asset, asset increase,